Welcome to the Canadian Investors Course, Session 11, more on packaged investment products. Again, slide 2, terms of use and disclaimer. Please read it. This time our cartoon shows a normal day at the nation's most important financial institution, suggesting that most of the people there are like sheep. They either all want to sell or they all want to buy. Not too much difference of opinion. So, moving on with more on packaged investment products. Well, we're going to look at today in this segment closed-end units, guaranteed income products, structured notes, funds of funds, target date funds, and REITs, real estate investment trusts. Let's start with closed-end units. Similarities to mutual funds. Well, first of all, they are an alternative to mutual funds. There's a set portfolio selling as a unit or a share, trades on the stock market, usually initiated with always initiated with an IPO. They usually start at $10 a unit, and they start trading from there. And they're going to trade at a discount or a premium to net asset value. They have professional management. They provide annual reports, and the portfolio is transparent. You can look at it anytime on the website. They tend to have a lower management fee than a mutual fund. They often pay dividends, and the dividends are in cash, and they are, if they're Canadian, they will be Canadian ones. If you buy Canadian ones, they're subject to the dividend tax credit. They have a net asset value, and they'll trade at a discount or premium to it, as I said before. The good news is they're very liquid. They can be bought and sold in the stock market, so they're not redeemed at 4 p.m. like a mutual fund. You buy them at whatever price you buy them at through the day. An example of an actual closed-end unit. Let's take the Dividend 15 Split Corporation. This is an investment corporation designed to pay monthly cash dividends. Corporation invests primarily in a portfolio of 15 dividend-yielding, high-quality Canadian companies. The reason it's called a split corporation is because it has two shares. It has the Class A shares, and it has a preferred share class. The preferred share class pays a set dividend, in this case 5.25% for 5 years. The Class A share is initially initiated at $10. It pays a dividend that is what's left over of the cumulative dividend after the 5.25% is paid to the preferred share, so it can vary. And any increase in dividends goes to the Class A share. And so if you're a Class A share buyer, it's called the capital class share because you're taking a risk and hoping that the shares will go up. The dividends that the underlying unit stocks in the portfolio go up, the preferred shareholder gets their dividend, and you get a rising dividend through success of the underlying portfolio. If you look at the list of companies, there are 15 blue chip companies in Canada, and since inception, Class A shareholders have received a total of $18.80 per share, and the preferred shareholders have received $6.71 a share, inclusive of the distribution, for a combined total of $25.51. That's a nice investment return. The price of the preferred unit, DFN.PR.A, on December 20, 2016, was $10.35 a unit and had a dividend yield of 5.10%. In other words, since it traded a little over $10, it had a little bit lower yield than the original issued yield price, which would be factored at $10. DFN, which is the capital share, was trading at $11 a unit and had a dividend yield of $10.90. So if you want the guarantees, you buy the preferred one. If you want to take a risk on the market, you buy the capital one. Note that DFN.PR.A has a set dividend. DFN receives any increased dividends, and so over time, That's worked out favorably, and DFN has ended up with a larger dividend of the two. The Globe and Mail Investor Online has the closed-end fund report. The link below will take you there, and you can find a list of Canadian closed-end units. Now let's look at guaranteed income products. A few other names for these are index-linked GICs, smart market GICs, or market-linked GICs. Typically, the idea is that you participate in in risk investing while having a guarantee on your capital. So, can you really have your cake and eat it too? They tend to run for 5-year terms. Some have a 3-year term. You'll participate in the growth of the market or the underlying instrument that it's assigned. The original investment's 100% guaranteed to maturity. And some have a minimal guarantee of principal and even a small return guaranteed too. But the key here is that the way that financial institutions can create these and make money is that the returns tend to be capped to the investor. They're simple to understand, but let's go over an example. And they're suitable for eligible for all accounts like RSPs and RESPs and so on. So let's take an actual S&P TSX 60 index-linked GIC, and we won't disclose which institution sold it, but it was a bank. So it offers a guarantee of principal after 3 years, linked to the Canadian stock market, no regular income, all potential returns paid at maturity in 3 years. So, for example, let's assume that after 3 years the market moves from 10,000 to 13,000. A 30% increase, that's an amazing market move. It's not normal. But in any case, let's look at how it works if you invest $125,000. You can look at the formula to calculate the return after 3 years on slide 11. I won't go into all that because it's not really that important. Let's look at the big picture. If we look at the calculation, it says that you can make 22,500. Assuming the market conditions we just described, you would make $22,500 as a total return on the 125 over 3 years. So the market went up 30% and you made $22,500. So where did the rest go? Well, first of all, how big are the fees? Obviously, some of it went in fees. Next, you'll notice, oh, you only have a 60% participation rate in the market move. Well, the other 40% goes to the company that created it, and that's their risk premium. And the index also pays 2.5% in dividends. Well, who keeps that? Well, of course, the institution that created the closed-end unit keeps that. They claim that the dividends are used to cover their administration costs. So, what are the problems with this product? Well, first of all, these products are very popular at market tops because the financial institution can point back at history to show what a great idea this would have been if you'd have done it 3 years ago. And typically people get more comfortable about the markets the longer that they're going up. And so a GIC investor looks at this and says, well, should I take 2% of my GIC or hope to get 10% out of something like this now that I can see that the market's successful? Clearly, if your return, if the portfolio made 30%, you made 22%, there's a lot of money in it for fees for the provider of the fund. Also, to make money on it, you need a very big move in the underlying index to make a decent return. Now, these products are available through full-service IROC advisors and bankers mostly. You'll find 90% of these products are sold through the banks, and the sellers don't usually have any idea how they're structured. Well, the next question you should probably ask yourself is, gee, why are the banks the only ones selling this? Why don't the IROC full service investment professionals sell lots of these products? That's a good question for your trusted wealth professional. Maybe they'd like to explain to you how they can get you a product that might provide better results with similar market conditions. Let's look at structured notes again. Structured notes take traditional securities like a group of stocks or an index, and through derivatives create an enhanced non-traditional payoff. The potential enhanced non-traditional payoff can lead to more than one outcome. Underlying securities could be a coupon bond, futures, options, or swaps. Retail investors can attain access to products outside of traditional stocks, bonds, and mutual funds, or ETFs through these structured notes too. The rules. Notes each have specific terms and set maturity dates. It's important to understand what the terms and so forth are. Sometimes with structured notes, liquidity can be a problem too, so very often they have to be held to maturity. There are principal protected notes where your original investment principal is guaranteed, similar to GICs, and there are also non-principal protected notes that offer specific or no downside protection on the original investment. As a retail investor, construction of these instruments is complicated, and there's no transparency in the product makeup or the credit quality of the issuer. So really, it's a question of understanding what you're buying. There are many variations on these notes. Some of them benefit from stock market drops. Some of them play a specific part of the market. Some are options based. Some are not. So there's a lot of these are custom made notes by the institutions, and it's important to understand the terms and the risk that you're taking. Generally, all fees, although high, are upfront, and if liquidity is available before maturity, it's usually only there's only usually one buyer, and that's the issuer, and therefore pricing may be a little bit opaque. At maturity, pricing's fair because it gets unwound and it's indicated in the term sheet up front how it's going to happen. Structured notes are available through IROC licensed advisors. Let's show a couple of examples to clarify. First example is a bank-backed product, principal protected note, credit ratings AA. The issue date was January 10th, 2017. Had a 7-year term, was 100% principal protected. It has a portfolio of large cap stocks, which is well defined. You know exactly what the portfolio looks like. And it will provide a variable return. The return is linked to the performance of an equally weighted basket of 15 Canadian companies with a cap of 65%. So there's no limit on the downside price performance of each share, and the note will return 100% of principal at maturity. So it means that you can only, the most the investor can make in this over the 7 years is 65% of the total return. Example number 2, this is a not principal protected bank product. Again, credit rating is AA, currency is Canadian dollars, term is 5 years, issue date January 27, 2017, and it contains 6 Canadian insurance companies. The payment at maturity will be based on the price performance from the portfolio, and includes 18% to come from cumulative dividends. The amount payable, called the redemption amount, on each 100% of principal amount per debt security at maturity will be determined as follows. If the percentage change in the portfolio value is greater than or equal to 64%, then the redemption amount will be $100. So in other words, it's an all or nothing thing. If the percentage of the portfolio is 0 or positive and less than 64%, the redemption amount will be $100. So in other words, if it's over 64%, it's $100 per percentage change. If it's under 60%, all you'd get it back is your original investment. If the percentage change of the portfolio is negative, then the redemption amount will be $100 plus $100 times a percentage change. So in other words, less than $100. All dollar amounts will be rounded to the nearest whole cent, and the minimum payment at maturity is $1. So in other words, it's conceivable that at maturity you might only get $1 back. So in other words, you participate in the downside and to a limited degree participate in the upside. Let's look at funds of funds. This is a multi-manager investment. It's an investment strategy in which a fund invests in other types of funds. This strategy invests in a portfolio that contains different underlying assets instead of investing directly in bonds, stocks, or other types of securities. It simulates a strategic asset allocation portfolio. The banks usually offer this product by a choice of 5 to 6 different pie chart portfolios. In other words, they identify your risk profile and then fit you to one of these fund of funds. They typically are a combination of stocks, bonds, and some money market funds. MERs tend to be a little lower than mutual funds, typically around 2%. They're available through most advisors who sell mutual funds, and rebalancing of the funds in the portfolio is practiced to maintain the client's asset mix without it's done automatically. They're a very popular approach, easy to understand. It's an easy way for the banks to sell a package of mutual funds. Very often they're managed fund type products and they're incented to sell them. Typically, they might be an income portfolio. The range of options might be an income portfolio, a balanced income portfolio, a balanced growth portfolio, a growth portfolio, and a maximum growth portfolio. So in other words, it's 5 ways of describing what they're going to do. And as you go up the chart, there's less and less fixed income in the portfolio. Up to the maximum growth portfolio probably contains little or no fixed income. Another managed product idea, package product idea, is the target date funds or units. Target date funds are a single fund investment strategy that are intended to help take the guesswork out of building and maintaining an age-based retirement portfolio. In other words, as you get older, you should take less risk. These funds try to anticipate that so that the investor can just buy the one fund and pretty much forget it for life. Uses of fund of fund strategies, and they shift from a growth portfolio to a balance, then an income growth, and then an income portfolio as the client gets older. So they basically move up the pie charts automatically. Now let's look at REITs. REITs are a type of security that invest in real estate through property or mortgages, and then they trade on major exchanges just like a stock. REITs provide investors with an extremely liquid stake in real estate, and they receive special tax considerations and typically offer high dividend yields. The properties are professional managed, and some of them are really very well managed. They tend to have a little bit of leverage on the property portfolio, but only up to about 50%. The nice thing for the investor is they're easy to buy and sell in the stock market, and they've got great liquidity. You also don't have any landlord problems. You don't have any specific property-related problems. The dividends are attractive, typically from 5 to 8%. Capital appreciation as property prices and rents increase tend to flow through to the REIT, and property depreciation and other tax benefits are passed on to the investor to reduce taxes on the dividends. One example of a REIT is Pure Industrial REIT. It's an unincorporated, open-ended investment trust that owns and operates a diversified portfolio of income-producing industrial properties in leading markets. They have target properties in primary markets. They're diversified across Canada. They buy in clusters and asset size. In other words, it's well managed, and it's a nice way of owning real estate in a very liquid form. if you want to see a list of REITs in Canada, see slide 26. And that is the end of segment 11. Thank you for listening.